Good afternoon, everyone. My name is John Ward. This panel is going to be getting underway. I'll give a few seconds to everybody to log in. We'll be starting in about 10 or 15 seconds. Again, good afternoon. My name is John Ward. I work with Duff & Phelps. I'm the head of their operational due diligence practice. We have a really astounding panel today to talk about cryptocurrency due diligence. I have a couple of housekeeping items I'll quick touch on. In your control panel, if you want to see us more clearly, please click to the full screen view. It'll make it a little bit easier. This is a live session. Everybody is here live. And if you have questions for any of the panel participants, you can put the question into the Q&A section at the bottom of the screen, and I'll be trying to monitor those, and I'll weave your questions into the conversation as best that we can. What you may have heard throughout today is that Duff & Phelps is going through an exercise of rebranding under the Kroll business name. So you will see both of those in the marketplace. It's bringing the whole firm together to work more closely. This whole conference is being put together by Duff & Phelps and by the IMDDA. The IMDDA, the Investment Management Due Diligence Association, is partnering with us. And if you're an institutional investor, I urge you to look at the IMDDA. They're your strongest advocate for institutional investors in the investment space. And I would urge you to consider looking at their website and becoming an IMDDA member. To just reintroduce, I'm head of the operational due diligence program at Duff & Phelps, and I've been looking at digital asset managers off and on for the last perhaps 3 years. I've worked with a variety of different allocators that are looking at opportunities around the world, and I've been on site with many dozens of managers. And I think this is a wonderful, wonderful panel that we put together. I'm going to ask each of the speakers to quickly introduce themselves, then we'll dig in. Kevin, do you want to go and kick off, please?
Thank you, John, and delighted to be a part of today's panel. I serve as an advisor, consultant to a variety of companies within what I call the blockchain digital crypto ecosystem. And I bring a lot of years, shall we say, of experience from my experience from Wall Street, from building and creating and building fintech companies, serving the biggest hedge fund managers in the world. And so delighted to join today. Thank you.
Scott?
Sure. Scott Army, CIO of Galaxy Vision Hill. Previous to that, ran as CEO Vision Hill Group, which we were acquired by Galaxy Digital about 3 weeks ago. So newly in Galaxy as a new business unit as Galaxy Vision Hill. Previous to that, spent the majority of my career at JP Morgan. Happy to tell you more about Galaxy Vision Hill, but more or less, crypto buy-side experts in many respects, investing across crypto hedge funds, crypto venture funds, and really any investable product now in digital assets.
Zach?
Yeah, hi, everybody. Excited to be here. My name is Zach Prince. I'm the founder and CEO of BlockFi. We are a financial services provider in the cryptocurrency ecosystem. Our platform is kind of two-sided. So we have a retail-facing suite of products that's also used by certain types of corporates that includes an interest account where folks can earn attractive yields on cryptocurrency and stablecoin holdings on our platform. They can also buy and sell cryptocurrencies and get a loan backed by the value of their portfolio. Later this month, we're rolling out publicly our fourth product on the retail side of the platform, which is a Bitcoin rewards credit card. It'll be the world's first Bitcoin rewards credit card, and we're really excited about that. And then we also have an institutional side of our platform where historically we've primarily been a lender, providing financing solutions to different types of institutional market participants that are active in the cryptocurrency ecosystem but can't finance that activity with their traditional PB relationships. Really excited to be on this panel. I think we've done a variety of work with everyone else on the panel. And maybe most notably, we had a partnership with Fidelity Digital Assets that we announced towards the end of last year, where we integrated our institutional financing into their digital asset platform. So not to front run Tom, but yeah, really happy to be here.
Tom?
Thank you, John. Good afternoon, everyone. I'm Tom Jessup. I am president of Fidelity Digital Assets. So you can think about that business in two parts. One is that we are an institutional brokerage catering to the needs of family offices, hedge funds, corporates, and traditional investors who want to make an allocation to digital assets. So we have a brokerage business exclusively focused on institutions. Last September, we also launched an asset management business through a series of private funds, giving investors passive exposure to digital assets through investment structures that are familiar to them. And in March, that organization filed for a Bitcoin ETF with the SEC. I've been with Fidelity for about 3 years. Prior to that, I spent 17 years at Goldman Sachs working in the strategic investments team, where my focus was around investing in and starting companies focused on institutional capital markets infrastructure, trading platforms, exchanges, market data companies. So glad to be with you all today.
Thanks, Tom. It's really great, and I hope that everybody can understand that this is really a preeminent panel of folks who are well experienced in this space. And if you have questions, again, feel free to put them into the Q&A, and we'll try to touch on them. Scott, if you don't mind, I'm going to come to you first, as perhaps the investor, if you will, in this spot, since you invest into these into various opportunities. Why don't you kick us off and give us maybe a little bit of history, as a way of saying it, the last several years, sort of where the process is, how we got there, some of the types of investment ideas, investment schemes that are out there, and where we stand now.
Of course. So prior to joining the Galaxy family, Vision Hill Group as a business, we've been positioned as a premier investment consultant and asset manager in the space now for about 3.5 years. Before you can make any investments into the space, you really have to gather as much data as you possibly can. So back in 2018, we began benchmarking work in the space, which included gathering data from hedge funds and putting together anonymized benchmarks, right, by which you could compare different assets. Those eventually became the Vision Hill Active Crypto Hedge Fund Indices, which we still use as a peer set comparison for various funds. And then we took that one step further and we developed that into what's now the Vision Track database, which is akin to, I think, a lot of folks on the call today will be familiar with a HFR or a Preqin or an eVestment type database. That's what Vision Track is, but just very specifically built for digital assets. We cover about 850 funds now in that database, about 400 on the crypto hedge fund side and 450 on the crypto venture side. Think of that as the top of the funnel opportunity set. And then from there, you can sort of whittle down to what ends up in our individual fund products on the multi-manager side. And so if you look at the opportunity set, it's actually matured significantly, over the last 3+ years. In 2017, a lot of the early entrants to the market set up hedge fund structures simply because they were able to raise capital in an evergreen structure. And so capital was not necessarily easy to come by in the early days in this space. And so it was easier to have a vehicle that could be evergreen in its life and continue to raise capital. As far as the focus on the investment side, it was very generalist to start. Folks would look at liquid markets, they'd look at private markets, they'd look at early ICO opportunities, really anything that could generate a return in a very nascent asset class. What we've seen now over the last 3+ years is that there's been a significant specialization of strategy, not only in structure, but also thematically, right? And so what I mean by structure is where it was very common to launch a hedge fund structure and perhaps do venture investing out of that in a side pocket. Now we're seeing, these structures be more pure play hedge fund, more focused on, liquid markets and risk management and better liquidity terms there. And then closed end traditional venture structures, 10-year type stuff that are focused on the longer term duration of the investments. So structurally, that's one thing. The other thing we've seen, as I mentioned, specialization strategy. So let's just take the hedge fund landscape for a second. Within that, we categorize by fundamental, quantitative, and opportunistic. What that means is the fundamental category is akin to probably an equity long-short type approach, but just poured into crypto and digital assets. So selecting assets based on fundamental, deep research that the manager believes will, accrue value over time. And in some cases, shorting assets where they, believe the value to be overvalued. You have to be very careful about shorting assets in this market, as it is a potential asymmetric upside space. That's in the fundamental category. That compares and contrasts with more of a quantitative strategy, which we've seen develop. And I think this is a category that especially through crypto winter, was in fairly high demand from an investor base, simply because it wasn't correlated very, very strongly to the crypto market beta. And so those strategies are more, trend following, mean reversion, any sort of systematic price-based quantitative approach. And they can take two forms, really. One, quant directional, which will be more participating in the ups and downs of the liquid market, and then the quant market neutral, which is truly, in many senses, uncorrelated. And so that's a bit of the specialization of strategy that we've seen on the hedge fund side. On the venture side, we've seen larger raises, especially more recently, early stage vintage funds coming back to market, raising fund twos and fund threes, now that they have a track record for investors to point to. And venture, to be honest, has been a category that's had fairly degree of success raising capital, simply because for many investors, they simply see this opportunity mapping well to that long-term secular trend, multi-decade trend in digital assets that for many fits well with a venture type investment that doesn't have, that the subject to the liquid market whims and the mark-to-market things that would normally be present in either a passive or a hedge fund allocation. So I think that's a bit of the specialization we've seen and the maturation. Can certainly go deep in any of those categories, but I think that's a good high level summary.
Sure. Great. Thank you. Zach, if I could sort of come to you, obviously what Scott was just talking about is a quickly maturing space where the earliest funds we saw were some of them were arbitrage between exchanges and things like that. That is pretty much out of the market now. As we go towards a more mature institutional investment space, getting access to capital, access to leverage, access to borrowing and lending and things like that, that seems to be, correct me if I'm wrong, that seems to be where you guys live, correct?
Yeah, and I think that I wouldn't say that necessarily the arbitrage types of strategies aren't as prevalent anymore, but I do think you have increasingly larger market participants from traditional asset management, including a crypto sleeve, into strategies that they run across market categories. We saw a lot of folks in the macro investing space start to get active in crypto because of some of the COVID related trends that were highlighted over the last year. And for a lot of these strategies, folks are looking to capture a premium or a discount to NAV in a fund product, or the basis in the futures versus the spot market, or differences in product pricing across different trading venues. And in every scenario, if you want exposure just to that market inefficiency, it can be really helpful to have access to borrow cryptocurrencies. And then certainly if you want to get leverage on a long position or capital efficiency in terms of your position sizing, borrowing dollars is helpful as well. And that's precisely the role that BlockFi has played historically in the institutional market.
Great. And then, Tom, when I was starting due diligence in this space, I had to quickly get up to speed with many of the organizations are not common to the traditional alternative space. So we don't see the big four accountants very often. We don't see the largest fund administrators. And there was real concerns about asset safety, asset security, cold wallets, warm wallets, stuff held on exchange, that type of stuff. I think having Fidelity enter the market in the custody space, and it has been a really welcomed. Can you talk us a little bit about what you guys are doing at Fidelity?
Sure. Yeah, look, I think if we zoom back out, we see blockchain technology as being a new strategic capability for financial services, even going so far as to call it a new operating system for certain types of value transfer. So, as an organization, we started researching this space many years ago and had started to develop, wallet infrastructure, trading infrastructure, ways to monitor public blockchain networks by running nodes of those networks and understanding at a very elemental level how transactions occur, when you see latency in terms of transaction confirmations and so on. And so, the way that we think about our business is that with that as sort of the strategic backdrop, we decided in 2018 when we'd started assembling a number of these capabilities on an R&D basis, what do we do with them? And at that point, the market was coming off of its last significant high. It was very retail-led. And we had an observation that, there were institutions allocating to this space, but it wasn't an institutional solution or capability. There were stories of family offices or hedge funds, sharing single logins to custodial providers or exchanges. And so what we decided to do at that point was really combine a lot of this new crypto knowledge that we had developed and this expertise through our own activities in the space with a lot of the thinking that Fidelity has as a broader organization around, operational controls, risk management, and how you actually run an institutional business. And that really gave birth to our business, which, first, the bedrock of this business is safety, soundness, and security around, custody of digital assets and private keys. We are, coming back to your comment about service providers, I believe we're the first or one of the first custodians to have a SOC audit done by a Big Four accountancy. We obviously we're highly regulated as a trust bank in the state of New York and regulated in dozens of other states. And as you can imagine, a lot of visibility and transparency in terms of Fidelity's own control functions and how it looks at our business. And I think what we find, and I think what you've alluded to, excuse me, John, is that it really has been more of an educational process, right? We wrote a research report over a year ago just focusing on why digital asset custody is fundamentally different than traditional asset custody. And what we found is that the more discussions we're having with institutions, we're finding that they are able to bridge the gap between their understanding of how things work in traditional finance and how analogous things work in the digital asset realm. And we are seeing a lot of uptake and interest in what we're doing, and quite frankly, a lot more comfort in what we and others are doing in the space. Now that we're seeing this education and this maturation of controls and process, validated by third parties. So we generally think the trends are headed in a positive direction.
Thanks, Tom. Kevin, you're sort of in the middle of a lot of these conversations. You work with a lot of different organizations as a consultant and advisor. One of the questions that came in through the chat was really to focus on the ODD side of the business. So coming to you, an institutional investor who would come to you or chat with you, you have a view across from the investor, from the technology to the opportunity. You work with a variety of different organizations. Where are some of the areas in due diligence that you think are really heading in the right direction to become institutional? And if put on the spot, is there areas that you say or think that there's still growth opportunities in the institutionalization of that part of the marketplace?
Sure, John. I do have the benefit of overlaying my experience, we'll call it traditional finance, Wall Street, building fintech companies 15, 20 years ago, overlaying that on this new evolving asset class, which I call it digital. Crypto is a part of it. And for years in the crypto ecosystem, we've been saying the institutions are coming, the institutions are coming. And I was quite sober that it was about, over the years of saying to a lot of the people I was working with, that it was going to take more time than they thought. And for the obvious reasons of, first off, an ODD is you're dealing with new assets, maybe natively digital assets, which require new or different service providers or new offerings from existing service providers. So when you think about this ecosystem, how do we get comfortable with the existing or the new service providers, whereby a lot of the people in the ecosystem don't realize that institutional investors, they don't want to worry about vendor viability. They don't want to worry about security. They're concerned with process and controls, and obviously we'll probably talk a bit about regulation, et cetera. So I think there is a sober reckoning in the ecosystem about what it is that we as an ecosystem had to enable and provide to give the comfort and confidence to institutional investors. If you overlay that with the challenge of there are not many, as you say, that with the exception of KPMG and Cayman, for years, we haven't had a Big Four audit firm in the US, at least, that was comfortable auditing a crypto fund or a fund that had crypto, or even one of their big clients, hedge fund clients, who decided to create a product obviously banking has been a challenge. I work with one of the biggest banks in the ecosystem, or the biggest bank. That has been a challenge. So I think the ecosystem has been on a march very successfully the last 3 or 4 years to create the comfort and confidence within the service provider community. And obviously I'm joined on this panel today by 3 of the biggest names in the ecosystem that do just that for institutions. So I think we're making a lot of progress, but we have to be sober about what it is we all have to do in this ecosystem to really enable the much broader institutional adoption of not just digital assets, but also crypto, which is unquestionably happening.
Sure. So Scott, if I could circle back to you, obviously you've been allocating into this space for many years. You come from JP Morgan, and your background prior to digital was, let's say, traditional alternative. As Kevin alluded to, there's new service providers, there's new counterparties. How did you get comfortable, and where are you with your comfort as an institutionalization when it comes to allocating capital to a fund? Clearly not every fund is operationally or has great processes in place. What are some of the challenges that you saw as you look to allocate capital to different managers who may have brilliant people looking at investment opportunities, but they have below standard processes, policies, and controls?
Yeah, it's a great question. I think, operational due diligence in crypto and digital assets is, if not equally as important, in some cases more important than understanding the investment due diligence philosophy of the teams. I think that's something, given the open source nature of this space, that if you track it long enough, you can get very comfortable with a lot of these teams on the investment side. But, I'd say translating from a traditional due diligence process into crypto is maybe a little bit harder lift, in the sense that you have very, very different service providers. You have very different diligence things. You have nuance that probably doesn't exist in traditional markets as well. So I think it starts with identifying who the providers are, right? And who the leading providers are, and why certain funds are choosing certain providers. What we've seen is a lot of folks are just bandwidth constrained. And I think that is a good thing in the industry, in the sense of they're busy, but these teams are expanding very quickly. And it's important to, not only understand the fund, but understand who they're relying on for both custody, admin, banking, et cetera, all the things that have been mentioned. So, part of that process for us is getting a touch point and getting very familiar and doing diligence, not to a crazy degree, but familiarity, at least, at the underlying service providers. And if there is a service provider put forth by a particular fund that is not on our radar, it certainly would raise a flag, and we would have to go further there. I think we've seen consolidation around some of the bigger banks, some of the bigger admins, some of the bigger auditors, and now there's commonality, which for us helps simply because we have those existing relationships in place now. But still, there's a lot of blocking and tackling that needs to happen in the diligence process. For example, something similar like asset verification. There's no standard prime broker report that you're getting from an underlying fund from a Goldman or Merrill or otherwise, right? And so, making sure you're calling fund admins, making sure you're verifying assets under management, making sure you're spot checking track records. For custody, it's understanding and getting comfortable with what is held in third-party custody and what perhaps isn't, and held in self-custody, simply because certain early-stage assets are not on offer at some of the custodians at this point. And they're building into those pipelines, but not all assets are on offer there. So what assets, what
Good news is you can
percentage
look at the blockchain, right? Some of the blockchain you can look to validate is this existence of assets. But again, that implies that you have to have people who understand how to do that.
That's exactly right, John. That's a good point, right? So a lot of this, in the sense where it is kept in hardware wallets, is you can trace to the wallets via block explorers to the extent the public keys for these wallets. And so you utilize all those tools, but those are very different than, I think, a traditional diligence process, to your point. Right. So it's important to get the skills.
And it doesn't get into the venture stuff that you were talking earlier. The stuff that is the early stage stuff is may not yet be on a blockchain or still in development.
Yeah, that's true. I mean, the early stage stuff on the venture side, a lot of those are taking the forms of, if it's equity, then it's a pretty kind of standard equity investment. But if it's tokens, usually they're taking the form of a SAFT, which is called a simple agreement for future tokens. It's based on the SAFE from Y Combinator concept. We've also seen, in some cases, equity investments with the right to convert into tokens over time. So there's a more comfort, perhaps, for more traditional investors. But a lot of that is paper-based investing in the sense until it becomes a tokenized investment. And then once it becomes that tokenized investment, there's usually vesting schedules, and that's when a custodian will come into play.
Zach, does BlockFi welcome? Scott was talking about verification of assets to the extent that a fund is using the services of BlockFi, and an investor or an institutional allocator wanted to come to you and say, can you help validate the existence of assets for a particular fund or particular opportunity? Is that something that you would support? And more broadly, your thoughts on institutional investors doing due diligence and working with BlockFi?
Sure. I mean, I think, that verification that we do regularly with high net worth individuals or institutions as part of their due diligence process and evaluating our platform is a bit more traditional. Like we have, a custody set up at BlockFi. We decided early on that we did not see custody as an area where we were looking to build, proprietary technology and add value into the marketplace. So we actually work with a couple of custody providers, including Fidelity Digital Assets. There's a bit of nuance in terms of what you can custody where, and when you're a business like ours that also touches consumers directly, there's components to that technology stack that are only available in certain places. And so there wouldn't necessarily be an easy way looking at, for example, a single blockchain address to verify how many assets are on BlockFi's platform at any single point in time. But it is really easy to look at a report from Grant Thornton, who is our auditor, or to review the financial statements that our team puts together. And in some cases, we validate with some of our third parties that are providing custody services to BlockFi on behalf of clients during that due diligence process. I would say that
is your customer base global?
Yeah, our customer base is.
I'm just going to briefly interrupt you. Is your customer base global? So you touch managers or investment opportunities from entities around the world, correct?
We do. So, on the retail side of our platform, the majority of our clients are in the U.S. About 65% of our client base is in the U.S. 35% of our retail clients are outside the U.S. market. We don't work with countries that are deemed high risk by U.S. or EU regulations, but we do have retail clients in over 100 countries around the world. And then on the institutional side, we actually expanded and opened offices in London and Singapore to help service institutional clients of ours based in the European or APAC regions.
Brilliant. Tom, I would think that one of the attractive things, as I think Zach mentioned earlier, was talking about traditional alternative managers who may typically be investing in securities, also may choose to have a sleeve of digital assets within their fund. I would think that would be a key opportunity for Fidelity, because you have a major NFS, which is a major prime broker for traditional alternative assets, and now you have digital assets. Are those two separate walled-off businesses? Do they work together? Or how do they interact between the digital side and the non-digital assets that may be within Fidelity?
Yeah, it's a great question. So look, for purposes of speed to market and purity of mission, our business was established as a separate subsidiary of our parent company. So we look like a peer to some of those other Fidelity businesses. We're separately capitalized. We maintain our own unique set of regulatory licenses. And the way it would work today is if you're an existing Fidelity client that wanted access to digital assets, right now it looks like a referral from one of the other businesses. Having said that, and one of the other panelists mentioned this earlier, really since the pandemic, we've seen a step function increasing the amount of interest and the mainstreaming of interest among institutions. And so we're seeing more opportunity to think about how we weave some of these digital asset capabilities into other parts of the Fidelity business. One case in point, coming back to my intro, was the set of fund products that we've launched, which are available to investors on the Fidelity platform, which looks a bit different than investing directly in digital assets, but is a good proxy and a very familiar form factor for many investors that perhaps haven't done all the operational diligence, or perhaps due to their mandate don't have the ability to invest directly in digital assets. So we're starting to see more of that movement towards the center, which is, as you said, John, is a nice opportunity for us over the longer term, not just for the current set of digital assets, but pretty much any other type of value that can exist on the blockchain in the future.
So if I'm a traditional hedge fund and I'm using NFS as my prime, can I use portfolio margining and post securities as collateral for digital asset investment through you? Are they sort of walled off businesses?
No, not through Fidelity, but we have a partnership, as Zach referenced, earlier in the presentation, where that client could theoretically custody assets at Fidelity and use those assets as collateral against a loan. So we would effectively act as a third-party collateral manager, which again, for big institutions, is really a touchstone of traditional finance that they're increasingly looking for in this space.
Okay, and your custody, they tend to be of all types of assets. They are mostly coins. Could it be early stage, sort of the SAFs and things that Scott was talking about? And what about derivatives or other things that are trading as derivatives to digital assets, or are you mostly focused on actual coins and tokens?
Yeah, I mean, we're very much, you can imagine that our priority list of custody is first and foremost a function of customer demand, which is sort of reflected in the market cap of current assets. So we're not seeing a huge amount of interest once you get past Ethereum, for that matter. Certainly for crypto native funds, it's the nature of their business where they need to custody all of these assets. But for traditional family offices, investment advisors, I'd say the predominant theme last year was Bitcoin, and coming into this year, it's increasingly ETH. Having said that, I think what's very interesting about the future of this space is we're hearing more discussion about tokenized securities, a lot of questions now about CBDCs, because that seems to be coming to the fore. So I think what we'll see over the course of the next year is that the demand function in terms of breadth of assets will increase dramatically. But for traditional institutions, it's largely a function of market cap at this point.
So when I spend $30 million on an NFT, I'm not going to custody that with you guys?
Not yet.
God forbid. Kevin, why don't you help? You kicked off sort of the conversation that we've been having here for the last 15 minutes. Maybe if I might ask you, we have about 15 minutes left or so. Just can we start to peek around the corner a little bit in that where are we headed? So we have large organizations like BlockFi who are acting in key roles of lending and leverage and asset availability. We have key performers like Fidelity who are helping with custody and safety and asset security. We are getting a bunch of different, Scott's going to guide us, as are many other people, in asset allocation. What are some of the areas that you see you talked about that we're not quite there yet? What are the areas that you think over the next 3 months, 6 months, 9 months, a year that we're going to see continuous focus on and expansion and growth in the institutionalization process?
Well, I think you have to start with regulation, right? We're all sensitive to the evolving regulatory landscape in the ecosystem, not just in the U.S., but globally. So I think as governments and regulators increasingly align with how to regulate or how to look at these assets, what's permissible, what's not, what is taxed and how is it taxed, all of these things will evolve and I think give a greater comfort to the increasing involvement of institutions. I think you're going to see a dramatic increase in simply the size of the digital and crypto ecosystem. And that's going to be very material because, again, so many institutional investors are limited by percentages of what assets they can hold, or maybe the volatility, which will come down naturally over time. I looked this morning out of curiosity to remind myself if Bitcoin was a publicly traded equity, a company, it'd be the 9th largest in the world. Ether would be the 29th largest. If you put all the crypto assets together, they would be the 6th largest. So we still have to maintain a certain perspective about just how big this ecosystem is and what that means to the ability of institutional investors and allocators to simply take positions that are meaningful, that may move the needle for them. So we're seeing a lot of different institutions put their toe in the water, increasingly directly, whereas perhaps previously they had done it indirectly. And I think of the CIOs of my two alma maters who I spoke to some years back, and I asked them about their exposure to the ecosystem. And their endowments had exposure, but they had them through their venture capital partners. And what's changed in the last year or two is now they're actually directly investing. So I think, what we're going to see is we're going to see a positive evolution of regulation. We're going to see a positive evolution of the service provider community, enabling and giving the comfort and confidence around what asset allocators need. And I think you're going to see new products that are also going to enable them to take positions and express views. And you're going to see an ongoing evolution of the breadth and depth of the ecosystem, as Tom was just alluding to, or Zach knows very well, and Scott knows, that beyond Bitcoin and Ether, the liquidity drops off dramatically. But what we're starting to see is the maturation of a lot of other digital crypto assets that are going to become of size, and they're going to warrant investment. And we're starting to see, I think, the spread of institutional allocation across the ecosystem. And then, as Tom just said, we're going to see the increase in tokenization of assets, right? We're going to go from digitally representing a physical asset, let's say in the NFTs world, we won't get into that right now, but to the natively digital. And I work with companies that are using the underlying blockchain technology to create natively digital assets. And I think that's at the forefront. So there's an enormous future ahead. And I think we'd all agree we're just scratching the surface of what this ecosystem is going to enable for institutional investors to gain exposure, gain performance, and take advantage of just a tremendous opportunity.
Great. Scott, one of the areas that I focused on doing due diligence on digital asset managers was around valuation. If a fund is trading in all liquid assets, and as everybody suggested, Bitcoin and Ethereum and let's say the top 5 or top 10 most liquid assets, we could probably come to quick agreement on P times Q, price times quantity, or something similar. Once you go outside of that top 10 or top 20 coins, or you start looking into early stage, valuation becomes a key concern, that as an institutional investor, that the assets within the portfolio are being accurately valued. Any thoughts or any guidance that you would give to an institution that is considering investing into these early stage investments or less liquid investments about how they can get comfortable with the hurdles around valuing the assets, or getting comfortable with how the manager is valuing the assets?
Yeah, of course. So I think every individual manager is going to have their own unique valuation policy. I think that's something that you have to dig into in diligence, is request that specific policy. In some cases, it should be spelled out in the PPM or OM for the fund, but in other cases, there's probably more granular detail and a separate valuation policy. And probably it's best practice that most managers have that separate valuation policy. That policy is then shared with the underlying fund admin to make sure that the fund administrator and the fund manager are on the same page as to marking and valuation of assets, either on a monthly or quarterly basis. What we've seen on the more illiquid side, and that means, early stage, or it could perhaps mean tokens that have a liquid market price, but may still be subject to a vesting schedule. What we've seen there is, again, in this conversation, is admin, fund manager, auditor, all involved in this conversation. That would be best practice for that. We've seen certain, haircuts to fair market value applied in those cases for illiquidity. In some cases, we've seen a Black-Scholes option pricing model applied to tokens, simply because you can observe a liquid price and you can observe, an assumption around volatility. And so you put those inputs in, and then you think about the vesting schedule for those tokens. Time is that last input there. And so that's how some folks are valuing the more illiquid token holdings in these early stage networks. Everyone's unique, though. I think it's everyone just has a defined valuation policy, and that it's followed consistently. That's the biggest thing. We are obviously, big advocates of fair market value. Just because someone wants to be conservative, and conservative may mean let's hold things at cost until we have, until we exit. That's not necessarily the best thing to do. You have to think about what's fair market value, what's consistent with sort of GAAP, what's consistent with proper audit processes, and then make sure everyone's involved in that conversation as part of that diligence.
Thanks, Scott. There was a question that had come up in the Q&A chat where people were asking if we were going to dig into valuation. I would just point to the fact that there was a separate panel within the due diligence insights agenda focusing specifically on crypto asset valuation. All of these webinar panels are being recorded. They're all going to be uploaded within a few days after the conclusion today to Duff & Phelps's website and also to the IMDDA's website. So if you missed that panel, you can go back and look at that. The crypto asset valuation panel featured Anthony Epman from Ikigai. It also had Curtis Spencer from Electric Capital, and we had Steve Nebb, who is head of Duff & Phelps's digital asset venture capital valuation practice out in Silicon Valley. So if anybody wanted to dig deeper into asset valuation, I would point you to that. For those who expected us to go into a deep dive in regulatory matters, there were other regulatory panels that might have discussed digital asset and that type of shot. So I just sort of wanted to focus on some in these last few minutes that we have at the last 5 minutes. Zach, I'm going to come to you and ask you to peek around the corner. You've talked about what you're bringing to market with a digital asset, credit card, back credit card, and things like that, which is on your consumer base. On the institutional base, if I could ask you to peek around the corners a little bit, and what are some of the next things that you think are going to be coming to market to support institutional investors?
Yeah, I think you're just starting to see derivative markets start to become sufficiently liquid for both institutions to get more active in those markets, but also things like structured products or hedging strategies, either for corporates or different types of exposures, to really make sense and start to get packaged up. I think that trend that's already happening with crypto-specific firms leading the charge today is going to be accelerated by large banks getting involved, which a couple are, very actively working on this. I don't think they're, in the market at scale currently, but I think a year or two from now, they likely will be. And all of this is, in line with just the steady maturation that we've seen in the marketplace. And, so increasing liquidity in derivatives markets, onshore, specifically derivatives markets, is one of the things that, hopefully will help the SEC get comfortable with, approving Fidelity's ETF and making that available. I think ETF approvals are going to trigger another wave of excitement and adoption of the asset class once that happens. So those are two things that I would highlight for folks.
And where we at, when you're saying derivatives, obviously the derivatives can be standard, puts and calls and an option. It could be futures. It could be, swaps of some type or credit default swap if you think something's going to go under. Where are we in that arc of institutionalization? Are we still in the options and futures, or that need to be grown deeper with deeper liquidity, or are you already thinking all the way up to the more complex derivatives?
We're in the early part with the futures market being pretty liquid, the options market getting increasingly liquid, but we're nowhere near stuff like CDS or swaps at scale today, but we're moving that direction.
Great, thanks. And Tom, could I ask you to peek around the corner a little bit? I won't ask you about some of the filings and some of the things where you are. I think that would be inappropriate. But I think you probably have from your seat some ideas what is coming down the line in the areas of custody or perhaps other areas. Any thoughts that you think that institutional investors should be looking out for?
I would just say, to pick up on what Scott and Zach both said, I think the trend of institutionalization is happening, and I would focus specifically on the intermediaries. Fidelity was early in being a traditional institution, providing services in the space, but as everyone in the audience has heard or read, this is quickly going mainstream. A number of large banks, other brokers, people who would traditionally be Fidelity competitors signaling intent to be in the market. So I think a year from now, there'll be a much broader range of, call it more institutional solutions rather than less, in bringing the industry to a level of professionalism and expertise that approximates what institutions are used to today from existing service providers. which really lays the foundation for the next wave of growth. Because I think what we've learned about the space is that every successive wave of adoption happens faster. It took 4 years for Bitcoin's market cap to get to $150 million. In the first less than 4 years of the DeFi experiment, locked value is somewhere between $65 and $80 billion. So once people understand how this space works and how transformational it can be, things will happen much faster. So we're very excited to be a part of it.
Great. And I apologize to everybody, but our time is up here. I want to thank Tom. I want to thank Zach. I want to thank Scott. And I want to thank Kevin. Brilliant thoughts. Thank you for sharing. Everybody, the contact information for all four of these gentlemen is available through the bug here, the website. If you wanted to reach out to them professionally, I think they would welcome your thoughts and sharing. Thank you for everybody who participated in this. And with this, we're going to have to conclude. Maybe there will be another digital asset panel that we're going to have to put together in the fall to dig in a little further. But again, thank you, everybody. I appreciate it.
Thanks, Scott.